Bank of England has signalled it may be finally done with rate hikes, or at least that was one interpretation of the recent February meeting. Officials are emphasising that a lot of the impact of all that tightening is still to feed through, partly because a lot of UK mortgages are on fixed-term contracts. Still, we don't think the Bank of England is done just yet, and we expect a final 25 basis point hike in March for two key reasons. Firstly, wage growth is showing little signs of slowing, even if surveys are starting to suggest that it might have peaked. The jobs market may be starting to cool, but worker shortages are still an issue due to long-term sickness and a lack of inward EU migration through COVID. Secondly, core inflation is a concern for the Bank of England. Goods price inflation may be starting to ease, and in fact headline inflation should come down quite quickly this year, but it's the service sector that's really worrying policymakers. By the time of the May Bank of England meeting though, things should start to be improving. There should be enough signs that the disinflationary process is underway for the bank to take a breather. Lower gas prices are good news for the service sector and should help to take some of the heat out of the inflation numbers. That suggests 4.25 should be the peak for bank rate. But we don't think the first rate cut is going to be that quick to come through, certainly after the US and the Federal Reserve. We're penciling in the second quarter of next year as the time for that first policy easing.